Hans Koiti, CIO at Finaport, joins us from Singapore. Hans, hi. And the good news this morning really is that the big hawk, Larry Summers, has opted out of the Fed race.
Well, it was a bit of a surprise, but then again, there would have been a very difficult approval process through Congress, and I think President Obama was not in a mood for that. Summers probably saw the wind blowing in his face, so he pulled out. Now, that again leaves the race open. The obvious favorite is Janet Yellen from the Fed, which is widely perceived to be more dovish than Bernanke. But I would think that there's not 100% a done deal, that she's going to be the one. There are other candidates somewhere waiting in the wings. I'm not so sure whether the president will appoint her, but I think that's what the market is expecting right now.
Hence, the front-runners surely are Janet Yellen and Donald Cohen. But whoever becomes the next chairman of US Fed, can one safely assume that the new chairman will follow a loose monetary policy and will follow a highly accommodative monetary policy? Because if Larry Summers would have become the new chairman of US Fed, he would have reset the entire regime.
Well, he probably has no choice, or she, whoever it is. I think it's a given that short-term rates will remain low, probably at 0 to 2015 at least. The tapering will come as early as this week, probably tapering light, something on the order of 10, maybe 15 billion reduction in asset purchases, which is very much in line with what the market is expecting. But the reality is that the U.S. economy is still not growing at escape velocity, so there's still some stimulus needed, but probably not as much as we have now. But we think that at the end of the day, the new Fed chairperson will probably have to be relatively expansionary, because the debt levels are still very high and the economy finds it pretty hard to grow. We have the debt ceiling coming up. So it's probably quite a difficult year ahead also in 2014.
Hans, all eyes are now on the Fed chief, and the markets this week are likely to be in wait-and-watch mode ahead of the minutes release on Wednesday. Is the start of tapering a foregone conclusion, or are we likely to see more confusion in case tapering is not announced on Wednesday?
Well, if there is no tapering, it would really add to confusion. That's absolutely no question. I think the market is expecting tapering, and I would think there will be not much of a market reaction if it actually occurs. But let's assume for a moment that there is no tapering. You could actually interpret this as the economy being too weak, as a problem somewhere that we don't see, maybe they see, and that would be downright negative for the markets. I would imagine that possibly we could see in the next few days, maybe even weeks, a rebound in U.S. Treasuries, a bit of a risk-off trade, but the bear market in U.S. Treasury bonds has started. It will not end. But for now, I would think we are expecting tapering, and probably the market reaction will be relatively muted.
Hans, let me read a portion of a Bank of America Merrill Lynch report, and they are making a 55% probability that on 18th of September, US Fed will not taper. There is a 30% probability that they would taper to the quantum of just $10 to $15 billion, and there is a 15% probability that they would taper more than 20%. So, Hans, if US Fed decides to taper, and if they decide to taper light, do you think that taper light effect is already built in emerging markets?
Yes, I think so. I think it's built into any developed and emerging markets. As I said, no tapering would probably be negative, because that would point to a problem somewhere which we don't see. But as far as emerging markets are concerned, we are now experiencing a rebound after the sell-off that we've had over the past few weeks, also in the currencies. But again, bear in mind the trend in U.S. Treasury bond yields has turned. Even if we do have a rally in the 10-year bond yield from 2.8 to 2.5 or maybe 2.4 or so, in the next few years we're looking at Treasury yields in the 10-year bond at 3, 4 or higher percent. And that, of course, has implications on fund flows, and we're probably going to see fund flows out of emerging markets, at least at the margin. And I think that's the risk that we have in the medium to longer term.
What is your call on India? Bullish, bearish, or cautious?
Well, India has had a very good rebound, and I think it's probably a bit overbought in the near term. Probably a bit of a pullback is possible, but I think there is renewed confidence with the appointment of the new head of the central bank. I think that's something the market wanted to see, and I would think that the worst is probably over for the rupee. It will still be relatively weak, but it will depend on many things like the price of crude oil, which we think should actually be lower than it is right now because political risks are receding. So I think that could well contribute to a little bit more positive environment for not only the equity market but also for the rupee.
So what do you like within India? Do you like cyclicals? Do you like IT, stroke exporters, or do you like the classic defensives?
Well, I would say the classic defensives will do because at the moment there's a lot of uncertainty and we don't want to stick our neck out too far. But as I said, we think that the worst is probably over for now at least, and we have to see where U.S. long-term bond yields are going in order to make an assessment. What is interesting is that foreigners still hold about 22% of Indian equities, and they have not sold because they tend to hold blue chip names. On the other hand, they hold very few Indian bonds. So I think from that perspective, that's a positive, and that's not, let's say, India will probably be less affected by any emerging market crisis than some other countries.
Hans, really good chatting with you. Appreciate you taking the time out and speaking with us today.